The broker has a pitch. Now you get a CPA, right? There's two sides of every offer, right? The seller comes to you and offers to finance part of the deal. Most buyers are like, "Oh yeah, this is great. No bank, less paperwork, deal gets easier." Seller seems confident, right? That there's no problem. But here's the question most buyers never ask. Why is the seller willing to be the bank? Sometimes the answer is great. Sometimes the answer changes everything about the deal. Today, I'm going to show you how to tell the difference before you sign anything. First off, what is seller financing? What is it? Okay, the seller does not take the full purchase price at closing. They carry a note for part of it, right? Buyer makes regular payments to the seller over an agreed term. It's like a mortgage, basically. The typical structure, a buyer pays 70 to 80% of the deal at closing, such as cash or maybe it's an SBA loan. But the seller carries 10 to 30% in a promissory note. Now let's go back to our example of the $300,000 business. The buyer pays $270,000 at closing. The seller carries the additional 30 on a note for, let's say, 6% over 5 years. Now, I will say this, most people will have a fixed rate. You really don't want to have a floating rate. Those become very, very complicated very quickly. So if the seller's willing to finance, kind of get a fixed rate. Now, the seller becomes your creditor, right? They have a financial interest in your success. That's just a part of it. And this is perfectly legal, common, and can be structured to benefit both parties. The reason behind the offer matters as much as the offer itself, the offer to carry the note for seller financing. Number one reason is usually the tax benefits for the seller are better. An installment sale treatment spreads capital gains tax over multiple years. It reduces the seller's tax in the year of the sale. Okay? This is legitimate. It's a clean reason. It's a good sign for the buyer. It also kind of shows you that the seller is financially sophisticated and the deal is probably in good hands. It's probably clean. The second reason, the seller has confidence in the business, right? The seller believes that the business will generate enough money to pay them back. They're actually leaving some skin in the game intentionally. This is the healthiest version of all for seller financing. Seller is a partner to your early success. They want to see you succeed so they get paid. Makes sense. The third reason, the business might not qualify for SBA financing. Maybe a bank looked at it and said, no, we're not doing it. Either the DSCR was too low, the collateral was insufficient, the financials didn't support the asking price. Seller is financing because no third party will lend on it. This will be your first major red flag. If no bank will lend on it, why are you buying it at that price? That's a really big question, and you got to ask it. Reason 4, the seller is motivated and needs the deal to close. Now, sometimes this is personal circumstances that drive urgency and can produce pretty good deals, right? Maybe it's a health issue. Maybe it's a family issue. We don't know. But urgency without transparency is a warning sign. And what I mean by that is if there's something going on in the business that he's not disclosing or she's not disclosing, and they see the signs of something coming in the future and they want to get out quickly, this may be something that they want to do. Motivated plus I won't answer any questions, it equals a problem, and a big one. Seller financing can protect you. Number one, it could reduce the SBA loan amount. A lower loan equals a lower annual debt service, which means a better DSCR, which means easier approval, right? The DSCR is so important. We got to know it. Let me give you an example. $300,000 business again, you paid $30,000 down. The $30,000 seller note is on standby, right? Only $240,000 SBA loan is needed instead of $270,000. That $30,000 reduction can make the difference between an SBA approval or an SBA denial. See, it aligns with the seller's interest with your success, right? The seller can't get fully paid until the business generates enough cash to pay them. So they want to see you succeed. It does create a natural incentive for the seller to give you a genuine transition honest handoff, real introductions to customers and vendors so that they make sure that handoff is good and those customers are still coming back to you so they can get paid. It gives you real negotiating flexibility. Now, seller willing to carry a note often means other terms are negotiable too, right? Can you negotiate lower interest rate, a longer term, or deferred payments for 1 year? With the seller, I'm talking about. And sometimes it can make a deal work that pure SBA financing just can't, right? The right structure, like a SBA loan with a seller note and a strong buyer, equals deals that get done. And it might not have any other way. So when seller financing is a red flag, let's go over some. The structure of an offer and the context around it tell you whether this is a gift or a warning. All right. Red flag number one, no third party lender will touch it. If SBA won't lend and conventional lenders won't lend, seller financing should not make you feel safe. It should make you ask harder questions. You need to get deeper into the financials, deeper into what's happening around the business, deeper into why this seller is trying to sell. The business may have financial characteristics that professional lenders have already evaluated and rejected. You got to ask harder and more probing questions. Red flag number two, balloon payment in the near term. Okay. Seller note with a balloon payment due 2 to 3 years means you owe the full remaining balance all of a sudden. If the business hasn't performed as projected, you don't have the cash and the seller can accelerate the note. This is a tough deal because all of a sudden you're paying these small payments and then bam, you're hit with the balloon. And now you got to come up with the cash. You got to always ask, what if I can't make the balloon payment? You have to ask yourself because you just don't know. You can't predict the future. You see what the past is. You got to make sure that you can pay that payment. Make sure you have the cash in the bank from the business for you to pay that balloon payment. Red flag number three, no non-compete tied to the note. If the seller can take their selling financing payments and open up a competing business next door, you've got a problem. Okay? The seller note and a non-compete agreement must exist together, right? If the seller resists tying them together, walk away quickly. It's over. Let me tell you something. They already have the customers. If they're going to open next door to you, their customers are going to say, oh, well, I can go over here to the seller and buy from him. They already know the vendors. They already know their customers. It's got to have a non-compete, and it's got to be the same thing as when you're buying the seller financing. Red flag number four, seller financing offered immediately and eagerly. Wow. Deal structure should happen after both parties agree on a price in basic terms. A seller who leads with, I'll finance it for you, before you've even verified the numbers is removing a layer of scrutiny you need. You got to ask, why is eliminating the bank from the deal so important to them? They may know it can't get traditional lending. It may cannot have an SBA loan tied to it. They may already know that. Red flag number five, no formal documentation proposed. Any seller financing must be a formal promissory note with specific terms in writing. Handshake seller financing is not seller financing. It's a verbal agreement with no enforcement mechanism. If the seller is resistant to formal documentation, man, that offer is not real. You have to walk away. All right. The terms that matter and what you need to negotiate. Interest rate, number one. Market rate for seller notes is typically 6 to 8%. Below 6% could indicate tax structuring, so you got to be careful with that. Above 8 is expensive. You got to negotiate that down. Now listen to me. Don't get a variable rate based on prime plus something. I never, ever, ever want you to do that. I don't think it's smart. Amortization terms are a big deal. 5 to 10 is the standard. Longer term always means lower payments, better cash flow in early years. Push for the longer terms. Balloon payment. Avoid this if possible. Please avoid it. If it is unavoidable, push it into year 7 or later. Make sure the balloon aligns with when the business should have financing options. And after year 7, you should be able to refinance the business with what you've done in business. Standby provision for SBA. All right, if you're using an SBA loan in conjunction with the seller note, SBA may require the seller note to be on standby for 24 months. This means the seller cannot receive payments for 2 years. Not all sellers will accept this. Make sure your seller understands before the deal gets structured around it, right? Let's talk about default provisions. What happens when you miss a payment? What notice period? What's the cure period? Negotiate reasonable cure provisions. You need time to fix problems without the seller calling for the note in full immediately once you miss one payment. You need to look at that. You need to make sure that you and your attorney and CPA have gone over that and understand it. Subordination. The seller note must be subordinate to your SBA loan. What that means is that it's after your SBA loan. SBA loan has a first position. The SBA lender is always going to be first in line. The seller will be second. This is a standard, but it must be in writing. You must have it in writing. What must be in the agreement? You must first have a formal promissory note, not a paragraph in the purchase agreement, but full payment schedule and dates and amounts, an amortization schedule with interest clearly stated, what constitutes default and a cure period, what the collateral, if any, the seller holds against the note, a non-compete agreement running concurrent with the note term, a subordination clause if SBA is involved, seller's release of any remaining claims at final payoff. That's a lot, but you got to do it. You got to make sure those things are in there so that you're not stuck at the end of it. Seller financing is a real tool. It's not inherently dangerous, and it's not automatically safe. The structure tells you everything. Know the terms. Understand the motivation. Get it in writing. I do want to remind you about the checklist. The due diligence checklist is in the Firewatch Business Lab on Skool.com. If you have not joined, we've had several people join recently. I appreciate that. And we're getting into some really cool stuff in there. Please come on and join. It's absolutely free. Firewatch Business Lab on Skool.com. The link is in the description. Now, if you're structuring a deal with a seller financing and you want a CPA to look it over, that's what I do. That's what we do. And we do that in the lab. You can contact me in the lab one-on-one and we can talk about any deal you got. In the next video, we're talking about the hidden costs that hit buyers in the first year of ownership, not the costs you found in due diligence, the ones that show up after you close and nobody warned you about. If you think your budget is set at the closing table, this video is going to challenge you at every assumption you've ever made on that. So watch it next. Guys, it's not about finding a deal. It's about avoiding a bad one.